Okay, I think we're going to get started. Thank you so much for coming. I'm Joan Young, the president of Sunbelt Business Advisors. By the way, Sunbelt is the largest business brokerage network in the world. We have over 235 offices worldwide. I believe we're in 9 countries. We are based in San Jose by the San Jose Airport, and we've been helping buyers and sellers throughout the Bay Area for over 14 years now. So welcome to the webinar on staging your company for sale. This webinar is part of our Sunbelt's Exit Strategy series that we've been offering to our clients for over 2 or 3 years now. And our webcast presentations are here to really educate business owners so that, you know, when you are ready to sell, you're going to be able to and move on to your next venture or retirement. You're going to be well positioned to minimize taxes and maximize what you're walking away with at closing. One of the biggest challenges for business owners is really not being ready when it's time to move on. And what this can result in is really getting a fraction of what your business is worth due to that poor planning or staging. So what we want to focus on today is how to stage or prepare your company for sale to just prevent these things from happening and, you know, being able to get the absolute maximum that you can for all your hard work. Today, I will be facilitating the webinar, but our guest speaker is Morris Chubb, who is with B2B CFO. Very impressed with Morris's background, and I think you will be too. He's a senior financial executive with 30-plus years experience in pre-IPO and publicly traded companies. He was previously a California CPA, which he's inactive right now, and he's really servicing closely held small to medium-sized firms. So he has introduced process improvements and technology solutions that have improved the operation, transactional, and compliance aspects of the finance department in many, many companies. He's managed cost and reserves and segmented operational reporting that allowed comprehensive scrutiny of key profit and cost centers of the business. He's overseen legal, HR, and administrative functions. Morris has analyzed, negotiated, and closed $8 million M&A transactions. 5 of them were on the buy side, 3 were on the sell, and he's also closed over $100 million in financing. So I think we're in good hands today, everyone. Good afternoon, Morris.
Good afternoon.
How are you?
I'm doing just fine. How are you?
Good. So I wanted to let everybody know that we will leave 10 minutes at the end for Q&A, and you can enter any questions in the chat box on the bottom left-hand corner of the screen as we go along, and then we'll cover as many of those as possible at the end. And if we didn't get to your question, just feel free to call either Morris or myself for more information, and our information, phone, and email will be on the last slide. So if each of you would put your phones on mute, we won't be interrupted by ringing phones, etc. So, Morris, you want to begin the webinar?
I will take it away.
Okay.
So good afternoon again. We're talking today about staging your company for sale. And I say staging because, as many of you probably are aware, houses today are staged in order to get the highest sale value for them. And I feel like a business can be compared to a house in terms of getting it ready for sale. I mean, we're not going to put in new lawn, but we may put in new processes or things that will help with the sale of the company. One of the things that I ask my clients from the very beginning is, what do you have in mind for this business? Where do you think it's going to go? How long do you want to operate it? What do you see yourself doing when you retire? Those things are good to have in mind from the very beginning. I'll give you an example. The other day I heard a Stanford Business School professor talking to the graduates of the business school, and she said, if we have 2 of you who negotiate your salaries, and one negotiates a salary that's $7,000 a year higher than your peer. All things equal, by the end of your career, that $7,000 a year will mean over $100,000 per year additional compensation. And that's the compounding of money. And so the idea here is to start early, start getting your company ready for sale early, do those tweaks. Not only will it be worth more when you sell it, but while you're operating it, it will return to you more income as well. Our next topic is going to be business as usual versus business for sale. Business as usual is running the businesses to keep your taxes low and your cash flow high. Business for sale usually means running the business in the last 3 years, running the business as a business in the last 3 years before a sale to maximize the sales price. One of the things you have to watch out for is the concentration of your customers or your clients. You may have 1 or 2 customers that are your most popular customers who come in or buy more products or services from you than anyone else. Now, while that's a good thing, it can be a bad thing for someone who's going to buy your company. You need to try and diversify as much as possible. And as you can understand, if you lose that one client, or if the acquirer loses that one client, that could compromise the business greatly.
And
another area, yes.
Morris, I just wanted to add an experience I had. I had a seller that had a very good buyer, but he was very concerned because there was 70% concentration with one client. And
wow.
So in order for him to feel safe taking that on, the seller had to stay on for 3 years in a sales capacity so that he could nurse that account along as well as bring in new people. And then they did an earn-out, which, they said, okay, I'll pay you your asking price. I think it was $2 million, but he said, I'm only going to give you like $1.4 million at closing, and that other $600,000 was kind of on hold to make sure over a 3-year period that they kept their numbers up, and they did. And it changed around. Instead of 70%, I think they got it down to 50%, but still they're working on adding new accounts so that wouldn't be such a high concentration. So just know, like you said, have the end in mind when you're getting a client. And of course, you're not going to turn business away, but you just need to make sure you're getting new business so that it doesn't take over. But this one turned out well.
And to that end, Joan, I think many transactions today do have an earn-out component. I don't know how much you're seeing of that, but I certainly, in the work I do, see an earn-out component in a lot of sales.
We're not seeing much of it anymore because numbers have come back so greatly since 2012. So we've seen 13 and 14, but boy, we did see a lot of them, in 9, 10, and 11, when people's numbers were just crawling back up slowly. They wanted to make sure they were going to come back. So it can be.
Right, and especially if you're getting the higher multiples in your business, your purchaser may be willing to pay that price if indeed the revenue is there. And so not knowing whether the revenue will continue, many of them do opt for, in order to pay you that higher price, or potentially pay you that higher price, they do opt for the earn-out.
Okay.
Another area of where a business as usual versus business for sale is in the accounting. And there are 2 predominant methods of accounting. One is cash and the other accrual. The reasons we usually use for the cash basis accounting is it gives you really a clear picture of what your cash position is. And typically It keeps your taxes lower. It's easier to do the accounting for. You don't need to take inventory. You don't need to amortize prepaid insurance or taxes. There's no need for accruals. And in fact, many of these terms that I'm using right now may be foreign to you because you are doing your running your business on the cash basis. The reason for the accrual basis is it gives a truer picture of the earning potential of the business. It's an accounting principle. It's called matching expenses with revenues. So if you have revenues today and the expenses you paid for 3 months ago, they're not really matched. So it's hard to tell what the true profitability is. Accrual basis does allow for that. Now, there's no need to run a business on the accrual basis, so it doesn't have to become complicated for you. A good qualified accountant can convert your financial statements from cash to accrual, which will allow a potential acquirer to get a truer picture of how the business is operating. We've also all heard about the small business person who funnels some of their personal expenses through the business. What are the hazards in doing this? Actually, Joan and I have had some conversations about this. One of them is it's difficult to have a supportable business valuation unless most of these, with these personal expenses being written off against the business. The price differential can be 2 to 4 times the amount of the personal expenses written off. I'll give you an example. Let's say there's a $50,000 personal expense. Maybe it's a vacation rental or a vacation second home that someone is expensing out through the business. Well, the delta for that $50,000 personal expense can mean $100,000 to $200,000 on a sales price. Mm-hmm. If you want the higher valuation based on the true potential of the business income with the personal expenses excluded, then your buyer will need to be able to, one, validate that those were personal expenses, and then be able to pay for the difference with their own money, or carry a note, or possibly an earn-out, as there's no ability for an SBA loan to address those types of expenses.
Maybe we should mention what SBA will allow. From my experience, it's typically interest, depreciation, amortization, and the owner's salary and the profit at the bottom line. But they don't allow car, insurance, any travel, entertainment. They don't allow those that are personal that you've added back.
Right. So how do you identify the different types of personal expenses? Well, it could be cash coming from the till that never gets accounted for as income. It could be inventory or supplies that is diverted from the business. So if someone is operating, let's say, a grocery store, to come in at night and take some groceries for personal use, that's that sort of diverted supply or inventory. Expenses that can be paid for by the business are personal insurance, personal vehicles that are not used in the business, travel, meals, and lodging that are of a personal nature, and payments to family members, sons or daughters who may be going to school or just not in the area, and yet a salary is paid to them. We're going to move now to the next topic, which is key employees. Again, Joan and I have had some conversations in and around key employees. And so, do you have any? Is the first question. And if not, why not? Key employees are valuable to the purchaser of a business. Obviously, if you're selling your business, you'll be going away. You'll be going to that tropical island or making that trip around the world. and you won't be there to help with the business. So who is there? A key employee. What do they mean to the business? Well, they mean the business continuation, both in terms of process and knowledge, as well as customer relations. And the next question is, when should they be brought into the equation if the company were to go for sale? Well, Joan and I differed on this. Joan feels that, and I'll let her support her case, I believe the sooner the key employees are brought into the equation, the better. You want to keep them, I mean, they will start to notice people funneling through, talking, conversations that don't quite make sense or do make sense, and they get the sense that the business is going to be sold. If they get that sense and are not brought into the equation, then they feel that they are going to be spun out of the business as the business is being sold. And that's really far from the thing you want to do. You want to keep them involved. You want to keep them with the business after it's sold, because that makes the business that much more valuable to the acquirer. How to keep them engaged. One of the ways of keeping them engaged is by giving them a bonus, giving them a percentage of the sale. Letting them realize that they are a valuable asset to the business and that they will have a job going forward, at least for a little while. I mean, there's no guarantee, of course, that the acquirer will ultimately keep them around forever, but certainly as they are a valued employee, they will be valuable to the acquirer.
Do I get to
Joan,
back up my position?
You absolutely do. I was just going to say, do you have any comments?
Okay. First of all, I'll comment on that, how to keep them engaged. And you had mentioned, giving them a bonus at closing. One thing that I've seen works very well for you as business owners is just your key people that, have really helped you get where you're going, helps you get to the sales point, is maybe give them a bonus at closing, but then another bonus in a year. And that ensures that they're going to stick around to help the new owner and not have any turnover, because that's the worst thing that could happen. And I've seen that work beautifully. I guess it was so funny because Morris was telling me his position. I was going, wow, that's the opposite of what we tell our sellers. But I understand your point in that if you have a general manager, somebody in charge of production, or somebody that's like your vice president and it's worked with you for years, yes, you can talk with them about what your plans are, and that it could be happening in the next 6 months to a year, but take them into your confidence and make sure they know that this should not be shared with anyone, and they will feel very special that no one else knows. But what I've just seen happen, the people that have already told all of their employees that they were going to be selling before I got to them, that they said that a few left because they just felt uncertain. They just automatically thought that the new owner was going to bring in their own people, and that's usually not the case. Those employees are very valuable to the new owner. So, I think I've learned just to trust the judgment of most of the people that we work with. They know the ones that are key. And one other point about this, if you don't have any key employees, it's what we call, you're probably running a business that's all about Bob. And I'm working with a seller right now that it really is a lot about him, and there are no employees, and when he leaves, most of the business will go with him in many cases. So I think that's something for you to look at. Your business is going to be worth a lot more if you do have some key employees. And you agree, don't you, Morris?
Absolutely. Absolutely. In fact, there's one other element about a key employee, is that he actually may have a rich uncle. And that rich uncle may believe in him and will help him buy the business. So one of your acquirers really could be your key employee. Just another reason for perhaps keeping them in your confidence.
Okay.
The next session here, this next part of this session, we're going to talk about the team that helps a company get sold. Many of these people you probably already know. Obviously, you know the business broker, Sunbelt, will help market your company. Will come in and help you with giving you a sense of value of the company. They have many skilled associates that will help you. You've probably heard from some of them already. I believe Joan had a tax specialist on the other day that gave you an idea of how to save money by structuring the deal. And so tax specialists are really part of the equation when it comes to the team that you want to have around you as you consider selling your business. Another person that is very valuable is a wealth manager. One of the things that a wealth manager will help you do before you sell is give you an idea of what you may need in order to retire in the style to which you've become accustomed. We all like to think that we don't want to change our lifestyle, and if that's possible, we need to know what it will take in order for that to happen. Your business may be worth every bit of what you will need, or it could actually be worth more, or it could be worth less. If it's worth less and it's not that much less, you may want to consider working for another year or two in order to bring the value up. Again, a good reason for getting good qualified people into the business to help you grow the business to make it worth everything to be worth everything you need for your retirement. The wealth manager will help you understand what you need, and then when the sale comes, they will help you with investing your money. You'll need an appraiser. Sometimes the business broker who will give you help with evaluation. The banker you need, one has probably helped you grow the business and can perhaps help the buyer finance the purchase. Sometimes there's a need of auditors and accountants who give an independent view of the accounting records and or perhaps convert your business from cash basis to accrual basis. At times you'll need IT specialists. If your business has an internet presence or you do a lot of internet commerce, having your processes well defined will be of benefit to the acquirer. Key employees. Like I said, I got employers down there, but it's employees, key employees. And we've just discussed that, and they are very important to the overall process. Insurance advisors. The insurance advisors are going to help you cover your risks so that any unforeseen occurrence doesn't bankrupt you.
And one thing,
Sure.
Could I just add, as far as insurance, what can also happen to make a buyer feel more comfortable is take key man insurance out on your life, the seller, so that if anything happened to you during, let's say, that instance that I told you about where there was 70% concentration with one account, and they needed that seller to stay on for 3 years to ensure that that account didn't go away, he did have key man insurance on the old owner's life, so that if anything happened, he would have gotten his investment back. So, whether it was $1 million or $2 million investment, you take that out on the life, and you're covered. So, I don't know if Morris, you've run into that very often.
There have been times. Actually, key man insurance is a double-edged sword. I remember a long time ago when a business I was involved in had key man insurance on the president, and the business was experiencing a bit of a downturn, and the CEO asked me jokingly, he said, "Do we still have Key Man life insurance on me?" And I said, "Yes." And he said, "Would you please remove that as quickly as possible? I'm probably worth more to the business dead than I am alive." So there is a double-edged sword to that Key Man insurance. So a word of caution, know your purchaser.
Okay.
The next person that is really important in the deal is a transactional attorney. Now, we all know lawyers, and lawyers come in many different sizes and shapes. They can be a divorce attorney, they can be a contractual attorney, they can be a intellectual property attorney, they can be a real estate attorney. A transactional attorney is really very valuable to you and your team, on your team, as they are very different than the normal attorney. They know how to structure deals to save you money. They know what the pitfalls are, and will be a real confidant in the process.
I can't stress that one enough. They're really going to help protect you so that once you've sold the business, you don't have to look over your shoulder to make sure that that you've been covered, or that the buyer can't come back to bite you for some reason. So, and we have 2 or 3 that are just excellent that we refer out.
And the last person I have down here on the team for a transaction is a trusted financial advisor. And again, as I mentioned earlier, the sooner that you start with the end in mind, actually the more your business will be worth, the more money you'll receive on an ongoing basis, as well as when it comes time to sell your business. So a trusted financial advisor does not have to work very, excuse me just a second, I've got something in my throat. Excuse me. A trusted advisor does not have to cost very much. They usually work on an hourly basis and help you make business decisions that are based on sound analysis and years of experience. So, Joan, that just about concludes my my presentation. I do want to mention briefly who I am and who I work with. As Joan mentioned, I am with B2B CFO, and we are the nation's largest CFO consultancy firm. I have had experience with small businesses as a CPA locally here in San Jose, and have had experience with large Fortune 100 and 500 companies as well. B2B, as a B2B CFO, we service the owners of privately held companies. Everything that we do is to improve their lives and to improve your life. Each of the owners is unique, as well as the business is unique, and they're important to our society. We believe that improving their improving their lives by removing the barriers that get in their way, and we have unique tools and processes to do that.
So you go in on a short-term basis. It could be once or twice a month for 3 or 4 months to get everything on track, or it could be for a longer period of time.
That's correct.
Okay, good.
One of the things that I like to do is to help a business understand where they might be missing things that they could be doing to make the business worth more. And so I will compare an existing business with other businesses in the same SIC code so that they can see how their competition is performing. Mm-hmm. And we do a comparison of those things and then say, let's see if we can't do what the competition is doing. Let's raise our capabilities so that we can be as competitive as the next guy.
Great. And sometimes it's pretty obvious, but sometimes owners are too close to it to see it.
Exactly.
Yeah.
Exactly.
I didn't see any questions. I'm going to, if you could write any question about staging your business for sale, or I could take you off mute. Why don't I take you off mute and see if anybody...
The conference has been muted.
Oh, I thought it says unmute. Sorry.
The conference has been unmuted.
So does anybody have a question about staging their business? We will keep you anonymous.
This is Elaine. I don't have to be anonymous. This is Elaine. I was always really, really partial to cash accounting. I just kind of liked to know where exactly I was, and accrual just seemed a little, it just wasn't exactly day to day. It was monies coming in, of course, expenses going out, and it gave a larger snapshot of movement. But if I really wanted precision, I liked the cash P&L, and still do. But it sounds like, Morris, you felt accrual had more value, or just offered something a little bit different. So I don't know if you want to talk about that a little bit more, and why you prefer accrual so much more.
Yeah, I absolutely understand your hesitancy to move to accrual. Number one, it is more difficult to manage. Cash basis is really quite easy. It's whatever you write checks for. But if it doesn't necessarily give you a true picture of the business. You buy some inventory. I don't know if your business has inventory. You buy some inventory in January, and you don't sell it till June or July. So you're not really matching the revenue with the expense that's associated with it. You pay for your insurance in September, but that's really for the whole year. And so you don't necessarily get a good picture of what, let's say, the October through December quarter looks like, because you're not spreading the insurance expense over the whole year. Rather, it's hit in September, and you don't have any expense for insurance in that final quarter. So that's one of many reasons why most large corporations run on the accrual basis.
But small
I understand
business...
cash is... Excuse me, I'm sorry. Please go ahead.
I was just going to say, but for small business, do you think it's okay to do cash, and then when they're ready to sell, if they want to have a truer picture for a buyer, maybe print out accrual?
Absolutely. It depends, of course, how you run your books. If you're running QuickBooks, which most companies do, you may or may not even then get a true picture of your accrual basis, unless, of course, you're entering things with the accrual basis accounting in mind. That means as soon as you get an invoice, you put it into the system with the right invoice date, number one. Number two, if you have inventory, you keep track of what you still have in inventory, because the inventory purchase is not an expense until that part of inventory has been sold. Again, you're matching revenue with expenses. So if you pull something off the shelf and sell it, then you should associate the expense of that item against the sale of it. If you purchased that inventory 3 months ago, then you're not really matching the revenue of the sale today with that expense, with that cash expenditure that you made 3 months ago.
Thank you. We have one other question. It says, once price is set on value of the business, is there a benefit to taking a lump sum versus a portion of the payment with the rest paid over a few years? I'd like to take that one. Scott, and then Morris, I'd like your input. Everybody says cash is king, and if a seller or if a buyer is willing to pay all the cash and not ask you for a note, that might be better. but it just depends on your tax situation. When you defer it over a 3 to 5 year period, which is typically the longest it's done, is you don't have to pay tax on it until you've received it. So that can be an advantage. And Morris, are there any other advantages to it?
Oh, there are actually many others. So if what you're doing is you're taking the sale price on the installment basis, then what you're doing is you're matching the cost of the sale with the revenue, and you're actually able to pay less income taxes overall because you're in a lower tax bracket. Additionally, what you can do is, as we talked a little bit about before, is that you can try to negotiate a higher sale price. Now that sale price doesn't have to be paid for right away, and it may be based upon certain things that you've put in place or certain projections of income that you have. And the buyer doesn't know that those will come to fruition, so they're less likely to pay that to you in the beginning, but are more willing to pay that out as an earn-out, if you will, over time as they see the income coming in.
I know it makes a buyer feel very secure when a seller says, oh, sure, I'm willing to carry 10, 20, 30% of the purchase price over a 3-year period if you'll secure it with property or other means that you could use. Then they know this isn't a fire sale, you're not going anywhere, you really believe in the business and you believe in them, and so that really cements the deal. If it's an SBA loan, they often will require that you carry 5 to 10% of the purchase price. But the deal with SBA, you typically do not get paid even interest on it for the first 2 years. The 3rd year you get interest, and after that you get principal and interest. So a lot of sellers don't like that with SBA, but there's some other positives too that I'm just going blank on right now. But yes, a buyer might pay more if you're willing to. What it does, it opens up a larger span of buyers. If you're going to have to get all cash for a $500,000 business, and it doesn't qualify for SBA, for example, then the number of buyers that are going to be capable of purchasing your business is much smaller. You say, gosh, I'll carry 30%. I had a buyer last year carry 50% of the business because they didn't really want all that money to pay tax on initially. They loved the buyer, thought they were going to be wonderful, which they have turned out to be really great, and so they carried up to 50%. So it brought in, that buyer would not have been able to buy it without her help. So it opens up your buyer pool for sure. Anything else, Morris?
I'm thinking of one other example. I have a current client who has a business that is fairly small, but with the right marketing, the business can be worth a lot more. And so we actually have been talking with a potential acquirer and been projecting what the revenues could be if that business did have an increased presence in the market, which is what the acquirer wants to do with the products. And so this company will be sold with an earn-out. And actually the earn-out, the upfront will be less than 50% of what the eventual value will be. And of course an acquirer will pay what they think the business may be worth today. And if you're talking about some future sales and the potential that you have put in place, then they're not willing to pay today for that, but will more likely be disposed to paying for that as an earn-out in the future.
That's good. And I've seen earn-outs which was different than what I was just describing, which is just a note. But an earnout, it's if a company is struggling, not doing well, but they know it's getting ready to make a turn, then it's almost necessary in order to even sell the business. And everything I'm reading these days is that the baby boomers are going to be, all of them, leaving their businesses and selling them within the next 5 to 10 years. And so there's just going to be an overflow of businesses on the market in the next 5 years, and there's going to be fewer buyers. So that's another reason for those of you who are considering moving on sooner versus later. It puts you in a little bit better position. But those that wait 5 to 10 years to sell their business, yes, you have a lot of time to position it and stage it and get it ready and work with people like Morris, but just know it has to look good, because there's going to be a lot of businesses. It's very sad because they're not going to be able to sell them, because there's going to be so many more businesses on the market than there are buyers. So that's why this staging is so important to really take note of. I think our time is up. I don't have another question, but I thank everybody for getting on today. Hope it was helpful. It will be taped if you know of somebody that would like to listen to it. And Morris, do you want to move to the last slide?
Yeah. There is one last comment that I'd like to make, and that is that while there are going to be a lot of companies, a lot of businesses coming up for sale in the next 5 to 10 years, there will be actually a lot of millennials who will start to opt out of big corporations.
Mm-hmm.
And Joan, I don't know that you haven't already seen some of this, where they decided, it's enough of this rat race. I want to run my own business. I don't want to have the business run me.
Mm-hmm.
And so there will be a supply of buyers. So you may not be ready today, and that may not be a bad thing totally.
Mm-hmm.
You may want to build the business more robustly. And
yes.
to build it more robustly, don't always rely upon your own knowledge, although it's steeped in experience. To take the advice from people who have also been there and who can help you run that business, I think it would be very prudent.
Thank you so much for your experience and your help, and thank you all for joining us. Good afternoon.
Well, it's been my pleasure.
Bye-bye.
Bye-bye.